Welcome to Between Two Fiduciaries. This week we're going to be talking about a hypothetical investment of $100,000 in stocks or bonds. And we're going to pressure test that over the last 10 and 20 years. Jimmy, this first slide here, we've got the last 10 years. So this is literally taking to the very date, February 22nd, 2023 to February 22nd of 2013. Tell me what you're seeing.
Well, I think the story here is pretty clear and easy to see. The purple line indicates the S&P 500 stock returns, and the orange line is indicative of the bonds. And what you see here is just a massive outperformance in stocks. And I think this is stocks have been the place to be for the last decade, and this chart illustrates that pretty quickly.
It really does. It's sort of a flatliner for the bonds. It's worth noting that those are 7 to 10 year Treasury bonds, sort of an intermediate term. So we're not trying to get too oversized or too undersized, kind of the nice middle of the road.
Yep.
And clearly, the picture says it all. Now you take the previous 10 years. Let's go back to 2003 to 2013. We've got a very different story here. One where the S&P 500 was really starting to outperform. We had a major downturn at the time, which was known as the Great Recession, right?
Yep. Yeah, I think it's really interesting. What worked in the last decade is oftentimes not what's going to work in the next decade, and I think that story is told pretty clearly here. I got to be honest. This chart really surprised me, even knowing the depths of the Great Financial Crisis in 2008. Still to see basically a complete wash between the stock return versus the bond return. I think what's interesting here to note, though, is the consistency and the boringness of the bond allocation there, right? Like there's just not a lot of volatility, whereas when you look at the purple or the stocks, you can see there's a good bit of gyrations, as you mentioned, in the 2008 Great Financial Crisis. We had a lot of volatility there, and you just don't have as much in the bond. So very similar return over that decade, but very different risk profiles in those investments.
Two different ways to get there for sure. Now, what I really like about this is I think it shows that correlation, the lack of correlation between stocks and bonds in this particular 10-year period. And that's not always true, right? We know that from more recent history, but here you're really showing the strength of having some bonds in the portfolio.
Absolutely. Yeah, I mean, academically, that's what it's supposed to be. There is a negatively correlated or lightly correlated asset so that everything doesn't bob and weave together at the same time.
So then we put it all together. We look at this now over a 20-year span. We go all the way back to 2003 to 2023. Wow, does it really give you a different viewpoint? And this, I think, speaks to the need to have a long-term investment timeline.
Yeah, I think it's easy for anybody really to get caught up in the here and now in the news, right? If you turn on any financial news media, they're making a great to-do about what's going on in that day. I love looking at charts like this because I think it brings perspective, even to us who are looking at these types of charts and graphs on a frequent basis. But I mean, look at how small of a decline 2008 looks like when given the proper context of 20 years. It now looks like a great buying opportunity. But if you were living in that moment, it certainly didn't feel like a great buying opportunity in 2008.
Absolutely. And I think, from a messaging perspective, what we want people to know is that this is not a pitch for stocks over bonds. It just says it gives you some perspective, and it does show you that typically if you're going to go with a high quality basket of stocks over the long run, they're going to outperform, and that's been shown time and time again. That said, bonds play a really important role in one's allocations, and so we are advocating both directions here. We think that there's a lot of interesting things to be done with bonds, especially now that you're reaching over 5% on a 1 year, and your 10-year is at just under 4. There's a lot of things to be done there, but don't forget, both sides.
Yeah, that's exactly right. This is, I think, diversification is a big takeaway from these charts.
That's it, folks. That's all we've got this week. Thanks again for joining us.